left field investors to Midloch Investment Partners Lunch and Learn webinar. That's Midloch, like the Loch Ness Monster, MIDLOCH.com. In our first webinar, we introduced Midloch. Today, we share 4 case studies of investment success, highlighting our approach as a value investor and the types of assets and markets we invest in. After the webinar, please let us know if you have any questions and sign up on our website to be notified of investment opportunities. Now, please meet Andy Sinclair, CEO and Principal, and Tim Donovan, Managing Director of Midloch.
Good afternoon. Thank you, Left Field Group, for hosting us once again. We're excited to come back and tell you more specifically about some of the case studies we have inside the Midloch Investments. My name is Andy Sinclair. I'm the CEO of Midloch and one of the principals here, joined by Tim Donovan, who's one of our managing directors. And we'll walk you through here over this lunch hour various ways we are a value investor and looking to unlock value. Prior to doing that, though, I do want to add one disclaimer that everything you see here is not a solicit to sell. We will provide you all formal legal documentation. Rather, this is meant to supplement your learning as you learn more about us. So who is Midloch? And I know we talked about this last time we had a webinar with the group, but I'm just going to highlight a few key pieces here about us as a group. So Midloch, we're a boutique real estate fund investment manager. We do both apartments, but that's not the sole thing we do. Industrial, office, commercial, primarily being retail properties. And we do both funds and individual real estate investments. Right now, specifically, we're targeting discounted and distressed real estate investments. And we're looking to earn a consistent 13 to 17% return using our unique investment strategies. Now, I will tell you, as you'll see on the screen here, we've been able to exceed that on exited investments, and we're hoping to continue to exceed our targeted range, but we're looking to make that consistent 13 to 17% range overall. As a company at Midloch, we've got about $700 million under management, and that does not include any of our prior history, which is in the multiple billions as a group. On the Midloch management side, though, including myself, I think one thing that makes us different as a group is that we're not just solely focused on just one type of background. So I've been a real estate investor primarily for the last 16 years of my career. My partner, Rafi Goldberstein, has been a lender, both for big and small lending shops, including those on Wall Street. And my partner, Josh Kurznak, has been a developer for the last 20 plus years of his career. The reason this is important is that we don't make decisions in a vacuum. All of our collective experiences that you see here in the middle, those all play a role in deciding, is this the right investment? How are we going to approach it? And you'll hear us talk more about that. So with that, I'm going to turn over to Tim, who's going to tell you a little bit more about our investment philosophy first.
Yeah, thanks, Andy. So really at Midloch, we have a few different components that make us a little bit unique from our investment approach, and a few of them are highlighted here. So one of those is that we really focus on what we kind of call the small to middle market space. We've always viewed that as having limited competition, and with that, that's really playing in this void in the market that is kind of above individual investments, something that you may own on your own, but also something that falls below the institutional size projects. Anything that we kind of call that 5 to 50 million, there's really limited competition, and that's the space that we like to play in. And in addition to that, we really emphasize kind of having a Midwest focus, but also a national reach. So we've got a network of over 1,000 real estate professionals, coast to coast, obviously a lot within the Midwestern markets that we invest in most frequently. And they really, those boots on the ground individuals, bring Midloch a significant amount of access to unique and off-market deals in markets that we really find attractive from an investment perspective. And with that too, I know a lot of groups really have kind of sole strategies, maybe only investing in multifamily or only investing in a given market. One thing that makes Midloch unique is our ability to pivot as the market changes. So not only are we investing in equity positions, we also have the ability, as the market dictates, to invest in debt positions, preferred equity, which we view as a huge benefit at a time where there's uncertainty in the market and there's really good opportunities to take advantage of these debt and preferred equity positions at attractive risk-adjusted returns. In addition, as Andy mentioned, we invest across a variety of property types. So while we do invest in maybe more traditional types like multifamily, We also invest in industrial, in retail, selectively in office and others. So we'll get into a little bit more about that as we go through the case studies. But the ability to pivot as the market turns is a huge factor in Midloch's success and business plan.
So I'm going to take this slide and tell you a little bit more, just briefly, why we're different. So everyone's going to tell you, they're the most considerate, or they're the smartest, or they've got the best business plan around. I'm going to tell you that all those things are important, but at Midloch, we always say we're looking for kind of 2 to 3 ways to make money. I'm not going to go into all of them right here. In the case studies, you're going to hear us reference all these consistently. Some of those things could be buying distressed properties, right? Looking for low rents, finding something that people don't see. Maybe it's green financing, and it's got to have all those criteria you see on the left-hand side of your screen. And we're going to wrap those all into how we approach deals thoughtfully and consider them. So with the first one here is our last mile pen property. So this is a last mile warehouse. It's right nearby the Minneapolis St. Paul Airport in Minnesota, nearby multiple interstates, so you can get to and from any part of the metro you need to fairly quickly. And so we were attracted. There was a Class B property that had all the right criteria that we just talked about. Location mattered, had the right attributes. But then we said, how does this fit into our value add oriented business plan, right? And so the first part we said of our business plan is you can't change what you paid for it. We were able to buy this at pretty significant discount. Couldn't buy anything near this today at $51 a square foot. Big discount, not only to replacement cost, but also what we felt was fair market value. One thing, the next thing we noticed as a group, though, as we're preparing our business plan, is the property was only 76% occupied. Little peculiar, given that the market is 95% occupied, so close to the airport, very tight submarket near the highway. So our second part of our business plan was, well, we paid a low price. Now we need to fix it. We need to get occupancy up, and we need to have local people lease that. Also, in all of our deals, I'm sure you hear this in every investment you do, well, the rent's always low, right? So same thing here. We felt that the rent was low and had a lot of growth potential and where it could go. And then lastly, one thing that's underappreciated in many of our investments is utilizing green financing. We noticed that this property qualified, given some of the retroactive improvements to the building, that we thought it could qualify for a private-public partnership here in the lending program. So let me tell you a little more about the outcome. So I told you why we liked it and what our business plan was going in. So ultimately, we bought the property in January of 2022. We paid about $11 million. First thing we did is we looked for any rents that were low, that were coming up for renewal, or new tenants we could lease. Immediately signed a tenant for above $5. So first things first, we got that off the plate, got a tenant up from $3 to $5. Really important. As I mentioned, we're believers, you always need to have a local team. This is nearby one of our offices. We had one of our best local industrial leasing teams work on it. Took the property from 76 to 91. That's good old-fashioned boots on the ground real estate to getting the occupancy up. Additionally, we talked about the price we paid. You can't change that. And so we got the occupancy up, got the rents up, put a green financed loan on here, and we sold it for about $15.4 million. Only held it about a year, and opted to sell it to a not only out of state, out of country buyer looking to enter the U.S. for about a 45% IRR to us, 65% profit overall. That's the equity multiple. Holding it for only about a year and change. So great deal. This shows very systematic in how we approach this case study here.
Another example that's still an industrial property, but very different than the last one, is our Life Storage Mequon acquisition in Milwaukee, Wisconsin. So this here, it also used to be an industrial building, really strong location, great freeway access. But where this building differed from the last mile pen example is it was a completely functionally obsolete building. It had been vacant for years, and the city that it was in really didn't know what to do with it. And ultimately, we came along with a local partnership as well as a partnership with Life Storage, and got approval from the city to convert the old obsolete industrial building into a Class A climate-controlled self-storage facility. So with that, it was a really unique case where the municipality did not want to provide any zoning for self-storage, but given the condition of the industrial building, they granted us kind of a unique instance of zoning approval, which is great for us because that limits supply risk of new storage facilities coming online. So the business plan here, like I mentioned, acquired this functionally obsolete building. It had been on the market and vacant for a long time, a really cheap basis of $37 a square foot. And through investing in the property, converting it into a 717 unit Class A self-storage facility. It was indoor, climate controlled, a wide variety of floor plans, as well as RV storage. And then obviously upon the completion of the conversion, to lease up the property at kind of competitive market rates to other storage options. And we were fortunate, given our location, that we were probably one of the best located facilities in this entire part of town. So the outcome here, as I mentioned, acquired the property in July, kind of mid-year 2021 for 3.4 million. We put a lot of capital into it to convert the interior, but in tandem with that, we completely redid the exterior of the building, the landscaping, the parking lot, invested an extra $6 million in, and in doing so, vastly exceeded our underwritten rents, underwritten leasing velocity. The project was really well received in the community. Shortly after, we received sort of an unexpected offer prior to actually reaching full stabilization. A group offered to buy the property for $14 million. And one thing that you'll sort of see in these case studies is we tend to be opportunistic when we receive an offer that exceeds projections, or that seems kind of too good to pass up. We like to take that. You'll see in these, a lot of times we'll have short hold periods. We're opportunistic at adding value and exiting deals maybe sooner than projected when the opportunity presents itself. So we originally proformed to sell the project for 11.7 million and hold it for a handful of years. We ultimately ended up getting an offer for 14 million in only about 1.2 years. So it ended up being over a 2 times equity multiple and over an 87% IRR. But that's an instance where we really like to take advantage of those opportunities when they come. One other example that maybe is a little bit more of a traditional example in the multifamily space, an investment strategy that many of you may have invested in the past. Villa Medici Townhomes is a great example of sort of what we do on the multifamily front. It was a 166 unit townhome community in Overland Park, Kansas, a really desirable submarket of Kansas City. Well, it was an older property. It had a lot of really nice, unique features like in-unit laundry, attached garages on select units. It actually had a man-made river that ran through the whole property. So great location. It fit a lot of our boxes of kind of being right for value add. And one thing here, kind of first part of the business plan, to what Andy said earlier, you can't change what you pay for it. And we had a really good opportunity to buy it at a discount from an out-of-state owner. They didn't live there. They were self-managing it. It was their only asset in the market. And because of that, not only was there a lot of operational meat on the bone, but we were able to get it for a discount to both market pricing and the tax assessed value. So we ended up, after receiving a $1 million COVID-19 discount, acquired the property for $25 million compared to the tax assessed value of 29. Now, once again, we look for multiple ways to make money. So buying it right is obviously pivotal to what we do. But we also saw an opportunity to invest in the property, to renovate unit interiors, cure deferred maintenance, and in doing so, to push occupancy and also to improve rental rates. And in doing so, we really wanted to bring hands-on local management. We had a local partner, a local management team, right, to really kind of change that property from that kind of out-of-state mindset. When we took over, it was 89% occupied. It didn't really have a clear business plan, so we were coming in to implement that. Kind of the outcome here, another really strong case of kind of bringing in that boots on the ground management and a value add plan. We increased occupancy shortly after takeover from 89% up to 98%, all while still achieving rental rate increases between 10 and 17%, depending on the unit type. And we were able to cure a chunk of the deferred maintenance. We were able to renovate part of the common areas, the clubhouse, as well as the pool deck. Did a lot of work to clean up the landscaping. We began hosting tenant events. It really drove retention at the property. It drove leasing. And ultimately, we bought the property in August of 2020 for $25 million. As we started to get into the start of 2022, we saw some cracks developing in the market. There was some uncertainty, obviously, in a variety of areas of the market. And we ultimately elected to sell it early, though we had projected to sell it or hold it for 5 years. So we paid that $25 million price in August of 2020. And in electing to sell it early, we ran a competitive marketing process and sold it ultimately in July of 2022 to an out-of-state buyer for $43.6 million. So another instance where we were able to actually exceed a 4x equity multiple to the fund in just about a 2-year hold period.
Now, while industrial and apartments are usually our 1A, 1B, kind of our top two asset classes, we do believe in being diversified and doing other investment types, such as, retail and inside the commercial. So this is a Target shadow anchored retail. It means that we own everything but the Target, because Target usually owns their own real estate, right? Also adjacent to one of the major local hospitals. Tenants we did have, though, were Chipotle, GNC, Subway, State Farm, some medical tenants near the hospitals. A lot of great tenants. And our business plan here was relatively straightforward. We acquired this at a discount off market from a large investment manager. They owned it a little bit longer than they intended. They did very well on it, but they owned it throughout COVID-19 and then several years prior to that. So their hold period got longer, and generally fund managers want to look to exit. Anytime it becomes longer because of an act of God like COVID, they're going to look to sell, right? And so we were able to buy it, a little bit of owner fatigue, even though they made great money. So we bought it at a discount. And they kept it occupied, but we thought there were several vacant prime suites we could lease up. We thought we could push rental rates a little bit. And then with retail, more so than other property types, is usually you have different buildings, right? You have an individual Chipotle or an individual Subway, right? And you can look to maybe sell those off to one-off 1031 buyers, or maybe sell to one large buyer. So relatively straightforward Class A retail plan. The outcome here was we acquired it in August of 2021 for about 12 million and change. The occupancy, we had our local best people on the ground lease it up. It's a group we've been using for over a decade, specialize in getting occupancy up here. Took occupancy from 90 to 97. We did push, rents mainly on renewals, but also when we signed new leases as well. And we were just starting to prepare to maybe sell this to one-off buyers. We were approached by a really large investment manager that used to be affiliated with BNY Mellon, who was looking to aggregate Class A retail, given that retail's got fairly strong supply and demand fundamentals. And so after only a year and change of ownership, they offered us about $16 million, resulting in about a 61 IRR, 65% total profit. Really great deal for everyone all around, but first things first, right? What we paid for mattered, getting the occupancy up mattered, as well as getting the rental rates up. So we had multiple parts to our business plan here other than just buying it because we thought it was a good property. Overall as a group, I think you've heard me and Tim give you just a handful of case studies. One thing I found interesting preparing to present to you is that even though the last few years have been a volatile market, Midloch is preparing to sell multiple properties right now that are going to be very similar to the case studies we just told you about. So even though as market cycles change, you always should be on the lookout for unique deals that have those multiple ways to make money, good investment characteristics that we think can make money throughout different cycles. So we'll be excited to share a fresh round of new case studies with everyone here at hopefully a later date. But just to recap, we remain a focused boutique real estate investment manager. We're not like the large Blackstones of the group. We try to take a more focused approach doing these small to middle market deals and trying to earn a consistent 13 to 17% return to our investors through taking our hands-on value add approach. And we're not too big, so we're going to work very hard for you as a group. If you like what you've heard from us today, the best way to get in contact with us is to reach out on the contact information on the screen. As well as I will add, if you want to hear more about the specific case studies we mentioned, we have a YouTube video on just nearly every property. Happy to send you those videos so you can kind of learn more on your own. So with that, I thank everyone for their time. Thank you for listening, and we look forward to continuing the conversation with the Left Field Group.